Stocks close marginally higher on Wall Street as investors await inflation data for the month of May. Asian markets trade mixed, while the GIFT Nifty suggesting a positive start for the Indian market. Crude prices gain. Brent rises above $86 a barrel as tensions rise between Israel and Lebanon. Gold too rebounds off two-week lows as the dollar weakens. Indian bonds will mark their entry in the JP Morgan Emerging Market Bond Index today. Indian government securities have seen inflows worth $8 billion so far this year. Analysts expect 25 billion inflows after the JP Morgan Index inclusion. Market regulator Sebi introduces new criteria for inclusion and exclusion of stocks in F&O trading. A new fixed price mechanism for voluntary delisting is also introduced. The regulator has also restricted registered entities from using unregulated entities, including finfluencers, to market their products. Reliance Jio hikes tariff for the first time in over 2 years. The average hike across various plans is around 20%. Also announces new unlimited data plans from the 3rd of July. Airtel and Vodafone Idea likely to follow suit. Good morning in the Mumbai News Center. I'm Sonal Bhutra. You're watching Power Breakfast. It's a Friday morning. It's the first day of the July series as well. So we have a lot to catch up on and a lot to talk about as well. But first up, as always, let's take a look at the Asian markets. They're largely mixed, but some of the gains, they are because of what we are seeing in the Japanese markets. So the gains led by Japanese markets, 1.1% higher on the Nikkei right now. The Taiwanese indexes are 54 points, but the Hang Seng, that is seeing some profit booking today, 34 points lower there. So it's a mixed picture, largely on the green side on the Asian markets. Now remember, yen continues to weaken against the dollar, so that is something we'll be tracking very closely. The Japan industrial output has risen more than expected in May, and South Korean industrial output, it has fallen 1.2% on a month-on-month basis. So a lot of macro data that we are tracking as well. But the GIFT Nifty is indicating that the start for our own markets will be in the green, strongly in the green actually, 107 points higher on the GIFT Nifty right now. After that stellar run that we saw yesterday, could be another day of green on our screen. With that, let's move on and talk about the US markets now. A muted day on Wall Street as investors are awaiting crucial inflation data. PCE numbers, which are closely watched by the Federal Reserve. The Dow and S&P 500 ended flat, while the tech-heavy Nasdaq ticked up 0.3%. Semiconductor stocks were largely in the red, while Micron sliding 7% and chip heavyweight Nvidia dipping 1.9%. The closely watched inflation gauge for the Federal Reserve, personal consumption expenditure or the PCE index for May, is due for release later today. Economists expect core PCE to rise by 0.1% on a month-on-month basis and 2.6% rise on a YOY basis. Okay, all right, that's the global market action, but how will these overnight cues impact our own markets? We have our research team joining in with what the trade setup looks like, the stocks that are likely to be in the news, and the action from the F&O space as well. Hey guys, a very good morning to all of you. Before we talk about the market setup, let's just talk about the cues from the F&O space. New series, so it's important to talk about that first up from us. Tell us.
It's a new series indeed, and who would have thought at the end of the June series, at the start of the June series, with the Nifty slipping below 22,000, that you would end the series above the mark of 24,000 and at a record high, and that is exactly what happened. And if historical data is anything to go by, the July series also promises to be an extremely good one as well. As you can see on your screens, the historical data for the month of July in terms of the F&O series, even last July we were up 4% on the Nifty, 22 we were up 7%, even in 2020 we were up almost 8%. So historically, a July series has always promised to be a good one for the index. The June series, as I just mentioned, was a promising one for the Nifty. Almost 1,550 points is what the index gained on for the June series, and it was the best F&O series that it had since December of 2023, which had almost 1,650 points. Now, over the last 4 series as well, the June series was a promising one after a slightly sluggish May series. This is the third positive F&O series we have had in the last 4 months. The rollovers also are coming in with a good start because of the 76.2% rollovers at the start of the July series compared to a 3-month average of almost 68.9%. So on the positives on the rollover front as well. We're starting the July series with almost 76% rollovers, and you can see that it's well higher compared to the last 3 months as well with April, May and June. The open interest at the start of the series for July is around 1.39 crore shares, pretty much similar to what we started off at the June series with around 1.37. So that is another thing that we need to keep into account. But you need to also keep in mind is that the Nifty lot size was revised to 25 from 50 in the June series. So you need to keep that in mind as well. The FII open interest, though, that's the one that you need to speak about more. We started off June series with net longs of 13%. We are starting this series at 82% net longs. So that is a turnaround from the FIIs. And of course, some key triggers to watch. Earnings is around the corner. They always are. So we keep an eye out on that. The budget, of course, the monsoon, the progress of that, and of course, global macros and markets will be in focus as well.
Oh, it's going to be a busy July, right? But thank you, Urmas, for joining us with all those cues. Vivek is joining us now. We'll talk about all the market cues we need to watch out for today. Good morning, Vivek.
Well, good morning. We ended June series on a high. What we have to watch out for today is quite a lot of individual stock-based action, something that the markets will look forward to. Now, first, having a look at how overnight action was. Overnight action largely muted to a slightly positive bias. That's what kind of handover that the US markets gave us. Now, talking about oil markets yesterday, once again climbed higher. Both WTI as well as Brent futures ended over 1% higher. Brent futures now hovering near the $86.50 a barrel mark. That continues to remain a key monitorable. Now, talking about the Indian markets continue to trade near record highs. Yesterday, you actually saw the Nifty cross the 24,000 mark for the first time ever, and the Sensex also crossed the 79,000 mark. What actually led to the strong rally? Reliance Industries, the outperformance that we've seen, especially in the last week and a half, continued over there, and expect a certain amount of it to continue today as well, as Jio has gone ahead and announced tariff hikes. Now, talking about what are the key sectoral gainer in yesterday's trading session, Nifty IT pack, the entire pack did quite well, and along with that, one particular sector that was in focus was the entire cement pack, given the fact that Ultratech went ahead and picked up a significant stake in India Cements. Now, talking about Asian markets and GIFT Nifty, both of them are indicating a gap up start. Key events and stocks to watch out for. Watch out, number one for the entire telecom pack, tariff hikes are once again around the corner. A lot of block deals. Remember, today will be the day where you will see most of the promoter block deal activity happening, given the fact that the silent period will start tomorrow onwards. So, Polycab, Sami Hotels, SCL Tech, you will see block deals over there. And also, one particular M&A action as well. JLW Infra has gone ahead and acquired a majority stake in Navkar Corporation.
Okay, all right. Thank you so much for joining us with all those cues, Vivek. Over to Abhishek Kothari now. He'll list out all the stocks to watch out for in today's trading session.
Well, to begin with, Reliance Jio, they have announced tariff hike in the range of 12 to 25%. There have been few board approvals. Ambuja Cement, a merger of Adani Cementation with the company. AU Small Finance Bank has taken a board approval to raise funds up to 5,000 crore. And RBL Bank has taken a board approval to raise about 3,500 crore of capital in one or more tranches as well. Now, block sources do tell us that SCL Tech, about 0.46% equity is on the radar. It's at a price of 1,414.9 per share, which is at a discount of 2.75% to the CMP. Polycab promoter will sell a little over 2%, and that will be a discount of up to 6.5% to the current market price. Sami Hotels GTI Capital will sell about 3% stake, and over here the discount is merely 1%. JSW Infra, their arm JSW Port Logistics, will acquire majority stake in Navkar Corporations. They get a letter of acceptance for a project from Southern Railway as well. Raymond shareholders have approved reappointment of Gautam Singhania as MD of Raymond. KPI Green, they have got a final sanction letter of credit facility for 686 crores for solar photovoltaic power project. Company had earlier raised about 300 crore via QIP for this project. Back to you.
Okay, all right. Those are all the stocks that will be on our radar. Quite a handful of them, actually. But time for a short break now. When we come back, Reliance Jio hikes tariff for the first time in over 2 years. We'll get you more on that when we return. Welcome back. Well, let's talk about the big news that we got last evening. Reliance Jio hiked tariff for the first time in over 2 years. The average hike across various plans is around 20%. The company also announced new unlimited data plans from the 3rd of July. Reema Tendulkar is getting us more details. Reema.
As you correctly pointed out, Reliance Jio has taken the lead and hiked tariffs for the first time in 2.5 years. This is much anticipated. The broad range of tariffs is between 12 to 25%. But on an average, it appears to be 20%. Just want to take an example of 3 plans. One is the base plan, the minimum entry plan. That has gone up by 21.9%. There are 2 popular plans. One of them is the 1.5 GB plan for 1 month. That's 28 days. There, the tariff hike is about 25%. 239 has become 299. The second popular plan is again a 1.5 GB of data per day for 84 days, which is basically approximately 3 months. And there, the tariff increase is about 20%. So 666 goes up to 799. So as I said, the broad range is 12 to 25%. Some of the popular plans have seen an increase of 20 to 25%, but analysts estimate on an average the blended increase should be closer to 20%. This is going to be effective 3rd of July. Now, again, what's the benefit to the financials of Reliance Jio? A 20% tariff hike. Now, there will be some extent of down trading, which means customers may fall off. Customers may choose not to migrate to the higher value, to the higher plan, the more expensive plan now, the same plan which costs them more. They may choose to say that, I'm willing to give up on some data and go to a lower value plan. That's called down trading, and that's always possible, and that does happen whenever there is a tariff increase. So while there is a 20% tariff increase on an average, it doesn't mean all the 20% flows through into your top line. Maybe 15-16 flows through into the revenues, but the benefit on margins is a lot higher because the costs are fixed. Now, what is the street going to watch out for? One, Bharti and Vodafone Idea. I suspect they're not going to waste any time and they're going to go ahead and announce their tariff hike, which should be on similar line. But that's going to be the first thing the street's going to watch out for. And 2, whether there is going to be any sort of down trading. Is this going to pinch the Reliance Jio customers, and will they perhaps try and give up on this, live with less data but pay a lesser amount? So that's going to be another thing that the street will watch. The stock is down well. Reliance Industries, Reliance Jio becomes a part of the consolidated Reliance stock, and that's a stock which has seen a gain of close to about 5.2% this week. So the street was anticipating a price hike. It's come through, but it's at the upper end of the expectation, on an average close to about 20%, but some popular plans have seen a price hike of more than that.
Reema, thank you so much for joining us with that analysis and all the details. Telecom stocks definitely will be in focus today. But let's move on. The health of India's financial system is robust even under a severe stress scenario, according to the RBI's Financial Stability Report. The report, which was released last evening, also warns about the risk from a build-up in retail loans and a potential rise in bad loans across non-banking financial companies. Ritu Singh is joining us with more details on this. Ritu.
It's a mixed picture that RBI is painting in the latest Financial Stability Report, even though it emphasizes that the financial system overall is stronger than before and both banks and NBFCs do have enough capital buffers to withstand macroeconomic shocks. However, in this stable environment, RBI says it remains watchful of any emerging risks. Now, banks' gross NPAs are at a 12-year low thanks to both lower new bad loan addition and also high write-offs. And sectorally, RBI finds agriculture has both the highest gross NPA ratio and the overall contribution to bad loans for banks. Now, RBI's macro stress test results show overall gross NPAs could fall further to 2.5% in the baseline scenario and remain at 2.8% in the medium stress scenario, but they could rise to 3.4% in the case of severe stress by March next year. In the worst case scenario, public banks could see gross NPAs rising to 4.1% and private banks 2.8%. The stress test also finds that capital adequacy of banks could fall even in the baseline scenario, but then this is not so unexpected. Now, importantly, RBI has raised a red flag on retail loans, saying that for private sector banks, the share of slippages from retail loans, excluding housing loans, in overall fresh accretion to NPAs is increasing, with retail NPAs forming 40% of fresh NPA addition in FY24 and the share of these loans in total advances at more than 21%. In the case of NBFCs, the stress test results show that even in the base case, bad loans could rise from 2.7% to 3.5% by next year, and capital adequacy could also fall, with as many as 8 NBFCs failing to meet the minimum capital requirement in case of rise in stress. But keep in mind, these test results are not meant to be a forecast, but just to measure resilience under a hypothetical stress scenario.
Ritu, thank you so much for joining us with those important details and updates from that report. Moving on, market regulator Sebi has introduced a new fixed price mechanism for voluntary delisting as an alternative to the reverse book building process. Sebi chairperson Madhabi Puri Booch also announced a new criteria for entry of a stock into the F&O market. The regulator has also restricted registered entities from using unregulated entities, including influencers, to market their products.
We had seen that there were difficulties for investment holding companies to be able to delist because of the holding company discount and other related matters. So we have now facilitated that through a scheme of arrangement, they can do selective capital reduction. And what this will mean really is that they will be able to pass on the benefit of the encashment of their holdings to the extent that they are holding liquid shares, listed shares, to their investors. And the requirement is that at least 75% of such companies, their fair value, should be directly in listed companies. Entities which are regulated by us, they are now being mandated that they cannot associate with people who do one of two things, either of two things. One is if they are not registered investment advisors or research analysts, and yet they are giving investment advice or research analysis. The second is, irrespective of whether they are registered or unregistered, if they are making claims on performance or in terms of portfolio performance, their service performance, etc., unless it is specifically provided for them to be able to give that information of performance. If they are making claims without that approval, then again they are breaking the law.
Okay, these are the takeaways from SEBI's board meet. But today will also be an important day for India's bond markets, for rupee, interest rates and the economy as well. Starting today, Indian government bonds will enter JPM's Global Bond Index for emerging markets. What are its implications for rates, rupee and the economy? Lata is standing by the wall with a detailed explainer. Over to you, Lata.
The name is bond, and I'll tell you why. June 28 is an important day for India's bond markets, for rupee, interest rates, and indeed the Indian economy. Starting June 28, Indian government bonds enter JPM's Global Bond Index for Emerging Markets, or GBIEM as it's called. Indian bonds are to have a weight of 10% in this index. The inclusion, however, will be phased, with 1% of the weight getting added every month till the full weight of 10% is reached in March 2025. Now, why are bond indexes important? The bond index is much like stock indexes, like Nifty and Sensex. Every pension fund and mutual fund around the world can't track bonds issued by every government all over the world and their macros, so they merely follow these global bond indexes. Now, what does inclusion in the JPM GBIEM index mean for India? Well, the total market value of bonds following the GBIEM index is about $300 billion. And so, inclusion in this index with a weight of 10% means that funds will purchase at least 30 billion of Indian bonds by March next year. That's the understanding. Typically, funds front run or come ahead of the inclusion. And dealers in India estimate that perhaps about $10 billion have already entered the country and are parked with various banks who could have warehoused bonds for these funds. Now, here's the month-wise flow of dollars into Indian government bonds. As you can see, from September, it's been increasing. That's when JPM announced the India inclusion. About 1 to 2 billion has been coming every month. As a result, foreign ownership of Indian bonds, which was as low as 1.9% of total bonds outstanding in September 23, has now reached 2.6% and is expected to hit about 5% by March 25. It's important to note that all bonds issued by the Indian government don't qualify to enter the GBIEM index. Only those bonds characterized as FAR or fully accessible route bonds are part of the GBI index. Earlier, in India, foreign funds were allowed to own only 5% of any bond. But in February of 2020, 4 years ago, the budget enacted a rule that foreign funds will be allowed to buy some bonds without any limits. These bonds are the FAR, fully accessible route bonds. This enactment was an important step in getting India into the global indexes. As of today, about $400 billion worth of Indian bonds are classified under the FAR. Now, what's the advantage of foreigners buying Indian bonds? The advantage of index inclusion clearly is that there is one more big buyer buying Indian bonds, and therefore yields are likely to fall, thus lowering the cost of government borrowing. And this in turn may reduce the cost of capital for corporates as well. Dealers estimate that since $10 billion has already flowed, in coming months, at least $2 billion of bond buying will happen in each month, every month until March. Additionally, in March this year, that is March 24, Bloomberg included Indian bonds in its emerging market local currency index. This inclusion is expected to take effect from January of 25, and the estimates are it will bring in another $3 to $4 billion into Indian bonds. Now, will such a huge flow of dollars lead to the rupee appreciating? Well, Standard Chartered sees the rupee rising towards 80 to 70 per dollar by the end of the current year. However, the Reserve Bank may well buy up a good part of the forex flows to keep the domestic industry competitive. Now, with falling yields and a stable rupee, India's growth story can get even stronger. So, not surprising, India's equity indexes have been hitting new highs for the past many weeks.
Okay, Lata, thank you so much for explaining that to us. So it's a big day today for the bond market and the other things as well, interest rates and economy. We'll slip into a short break. Up next, we'll get you all the cues from the commodities market. Stay tuned. Welcome back. You're watching Power Breakfast on CNBC TV18. Let's talk about the commodity space. A lot of action there as well. Manisha Gupta is joining us with all the update as always. Hey, Manisha, good morning. Is it a happy Friday for the commodity market?
It's a mixed bag, really, Sonal. At the crude oil prices, we're trading at a 2-month highs onto this one as there are escalating conflicts in Middle East. Now, there is stuff happening between Israel and Lebanon, and Turkey has expressed support for Lebanon against Israel. So the markets are looking at small regional concerns yet again cropping up, and that is supportive in case of crude oil prices. That is the reason you had the gold prices also rebound from its 3-month lows. Also, the U.S. unemployment number has increased, and the markets are anticipating that you will see rate cuts from Bank of England and China in the month of July. That seems to be keeping spirits high, but not so much for copper, which is trading at a 2.5-month lows because there is strength in US dollar index. The China industrial profits in the month of May are at 0.7% from 4% in the month of April. So that really seems to be weighing on in sense of copper, which is headed for a negative June. A very quick word, I want to talk about sugar as well because we've seen 4% of gains in the international markets. Sugar is now trading at a 2-month highs. This is because the sugar exports from India still continue to be curbed, and below normal monsoons in India and Thailand are weighing on to crop and yields here, and that is another supportive factor.
Okay, all right. So that's what's happening with the commodity markets. Thank you, Manisha, for joining us with all those updates. Potential debate, but let's shift focus to the T20 World Cup. India eased past England in the second semi-final of the T20 World Cup in a match that was repeatedly threatened by bad weather and rain. India lost the toss and were put into bat after a rain delay and managed to put up a total of 171 runs, led by steady partnership between Rohit Sharma and Suryakumar Yadav. Chasing, England were picked apart by India's spin duo of Kuldeep Yadav and Akshar Patel, who picked up 6 wickets between themselves to bowl England out for 103 runs. Team India will now face South Africa in the World Cup final on Saturday night. Okay, all right. Before we wrap on the show today, we would like to wish good luck to the producer of the show, Madhuvanti Srinivasan. It's her last day with CNBC TV18 today, and she produces other shows like Trading Hour and Business Lunch as well. We would like to wish you all the best for all your future plans, and you will be missed. All right, with that, we'll take your leave on this edition of Power Breakfast, but Bazaar Morning Call comes up next.